Hey, what's up? This is my daily review for Friday, November 16th. It's about 8:30, and just want to go through the trades from today. Excuse me, and kind of look back at the week. A really fantastic week. I think this strategy is going to be really good for us. And I'll show you what I'm coming up with for as far as sizing goes and how big of an account you need based on that, on what size you want to trade, and so we can show you how it's kind of scalable. Um, anyway, first thing we'll do is look at the chart for today. So starting at the 4,000 tick level, here are all the levels that were in play today. We had these are the major ones anyway. We'll zoom into the smaller ones. There's an opportunity that we missed up here. It's a little harder to see on this 4,000 tick, and then there was an opportunity for a long here that I'll show you here in a minute. But zooming into the 800 tick, here's what the morning looked like. Typically on Friday, you'll see pretty good action in the morning, and then kind of after that 10 o'clock Eastern time, it kind of just dies off. Yet again, we were eyeing two entries that were right around inflection points. So when I talk about these inflection points, I mean entries right before it starts making a big move. Sorry, still dealing with this stuff, this junk. So the first one was this 1-2 that you see here. So we had a 1-2, and then this was our buying area, and I'll kind of analyze what I was thinking and why I missed it, and I recorded it live so you can look at that. And then up here, what I was thinking and why again I missed it. I was too slow and didn't act accordingly. So anyway, take a look. This is what I came into today. I think I came in about 7. It's a little bit late today. So I was like almost up here at this highs when I came in. So I saw that we had a two leg move higher. And again, talking about those measured moves, those are those yellow lines. You can predict kind of where the market's going to go based on how far it's come. So here's where you put the first major move, and you just copy and paste and put the second major move at that next lower low. Put that up, and even before it gets up here, you can put your arrow in here, and it actually went to the tick. It's not this yellow line. This yellow line is for another swing. It actually should be red. I made it yellow because it wasn't a major swing, but the measured move kind of corresponded really closely with that, so I didn't put that line on there as well. So I figured if we could get above that, that'd be a pretty critical error. It's not only a measured move, but it's also that prior swing. All right, so zooming in a little bit. I have the range box on here because we did end up getting a double bottom. We can kind of shift that aside for now because I didn't see that obviously when I was looking at the charts. So what I had to look at was, all right, I'm coming in about here. So we've made all these highs. We didn't get up there. We didn't get up to that high. So maybe my first thought was maybe we had a 1, a 2, and a 3 push over that 13 level and then pull us back down. We never got that high, so then we start looking on the opposite side. So we have a little bit of a swing here, and we have a more major swing here. And so what we had was a move down 1 and then pulled back all the way to the moving average, which was perfect. And then we had a move down 2, and then it did exactly what it did yesterday. So it did this kind of like bouncing along that support. So that meant I want to use this level as my entry level, and I don't want to use this level. My first thought was, all right, let's get a 1, let's get a 2. If it blows through the 2, I'll use the 50 level. If it doesn't blow through the 2, I'll use the whatever this was, the 60 level. It didn't blow through it. It kind of hung out. So I waited and I said, all right, I need that close below this. There was my first close. So my entry should have been ready to go. I should have had sell. I'm not connected, so whatever. I should have had that sell ready and then could have popped it up there. Once I saw that bar counter go all the way down to like 10 orders left, I should have popped it on there and got filled in, which would have been perfect. The market immediately shot up. I saw it close, and then the market was already like up to here by the time I had my order ready. So it was my plan all along, and I waited just a second too long. I didn't put my order in there. But what I would have liked to got is like, let's say I got the 59, so we'd be looking at the 69 to move our stop, and then we were looking at I don't know, 70. What is that? 74 to get our target. So it'd been like right up here. Ended up popping right into it. So that would have been our 15 tick target. Take that off, and then it pulled back. It would have wicked us out if we had that remaining contract as a runner, but it did end up making, and that was kind of the apex of the move as it moved higher. So another option here would have been to be a tick below the low of this candle. If you wanted to have a little more risk on the trade, you could put tick low. You probably would have still gotten stopped out and been even more frustrated because you got actually the bottom very last tick before then shot up. So that was that trade that I missed. Because it put on that double bottom, I didn't want to buy anything else because I knew if it went up, it was going to come back in. Or likely that would have been the case. It didn't happen here, but we've seen it before. So this was kind of the range that I identified. Which you can see it tagged it there, tagged it there, tagged it there, failed on it there, and then it kind of broke through and went. So it is what it is, but it's good that we're in the right spots, right? I mean, we're beating ourselves up if we're not 2 or 3 ticks off the freaking bottom here. So like there's no better place in my opinion to have gotten into that move. I also kind of wanted to wait in between these two lines, say like 55 or 56. Which in hindsight, if I would have put my order just at 56 as it was moving down, potentially that would have got ticked in right there. But the thought process there was, all right, if I get in at 55, 56, and it decides not to use this level, then I have it, and I have 10 points, so I would go down to 45 for it to potentially use this level. So it kind of was like, well, if I don't want to get in up here because then I would get stopped out here, but if I could get my stop lower, then I have more opportunity, which ended up obviously working out if I would have got in, but it didn't. So it is what it is. Keep moving here so I can be done with this for today. So interesting deal here. We don't start counting the ones and twos until we see this strong move away from the moving average. So this becomes the start of leg 1. No pullbacks. You can tell no pullbacks until it actually hits that 13 level, and then it pulls back, and now we can count it as a 1. Actually didn't label that one. So we can count that one as a 1, and that pull back, and then we would be looking for a close over that 13. It's kind of a weird deal because that level also corresponds with the previous level that it put in. So it's a little bit harder to be confident about it, but at the end of the day, we have to take these because this is a clear, if I scroll over to this red line, it's a clear kind of point in time there. It's not super strong, but it's definitely a level where it would be a potential turnaround spot. Excuse me, which it ended up being. So it worked out really well as far as our analysis went. So my thought was, all right, if I get the touch here and I get the pullback, then I'm going to sell it when it gets back up there. So here it was again, perfect closed candle. I moved and put my order in, but I was too late. So I need to learn to watch that counter as it's counting down to like 20 orders and get ready, open up, click on my order, move it, get it ready. And then when that gets to 10, 9, 8, the problem is sometimes it goes really quick, but when it gets to like 10, go ahead and click it. This candle's gonna close above the line. I mean, 3 or 4 orders is not gonna send it back down. I mean, it potentially could, but you want to be ready and entering into that trade. So you would put that order in there. Ideally, you get filled at like 15, 16, which was the absolute high of the day. So again, we're talking about the apex of these moves. If you got in at 15, you move your stop down at 05. Excuse me. If you got in at 15, you move your stop down already. 15, 5. Been a long day. So in the very first candle, you would have already moved your stop down to point of entry, and you would have never been ticked out. So you would have been looking for 58, right, for your target. So that would have been your 15 right there. And then if you still had that 1, you'd move your entry down or your stop down right to 15, and it never touched 15 again. So this is one of the cases where this one stopped you out, which is fine because you got your profits in and you're stopping out break even, whereas this one didn't get you out. So it's just taking the shots when they're there, taking that shot right there, and then letting it go. So if I wanted to do, had 2 contracts, say, take the one off there, which I'll show you why that's not advantageous. But if you had 2 contracts, take one off there and then let the one run. And so my target would be Just like my target down here was to go back up to this high, my target would be down to go back down to this high, which it absolutely does really easily. So that's a 50-point move for a 50 tick move, a 50 cent move, however you want to say it. So that's $500 on that one contract. So trading one contract on each of these, this would have been a $150 winner, and this would have been a $150 winner, so that would have been $300. If you had a 2 contract day, this would have been a $150 winner, and then stop out break even, so I'm plus $150. Now I'd be plus $150 again, so I'd be plus $300, and then I wouldn't have gotten, right here's where I entered, so plus $350, plus $150, excuse me, so I'm up $300, and then it never triggered, so if I'm patient enough to get down to my target, it would have been another $50 or $500, so 5, 6, 7, 8, almost $1,000 a day, before 9 o'clock. So that's the power of this, and we're really on to the apex of these moves. So if you had even more contracts and you were super patient, you could have just trailed this thing all the way down. Been making these huge giant moves lately. Trail it all the way down. You were in at 50, above even 58, and it gets down to like 56 something. So a couple $1,000 if you're patient enough. Personally, in the long run, maybe if you have enough contracts you're trading, but in reality, you're going to want to probably take that first at your point here. You would just take that right here, or maybe even somewhere in the middle, take 30 points, take $300 off of it. That turns you in from a $300 day into a $600 day, and you call it good, right? And after that, you pack it up and you come back later and just look and see if you missed anything, learn from it, etc. Or, simulate trade after that, because there'd be nothing worse than going up 600 on 2 perfect entries and then giving it all back. So keep that in mind. And that's a little bit of a psychological battle too. You can't be afraid to enter the trades, obviously, and you can't be revengeful when you're making the trade. So if I was revengeful and I sold this here and then I immediately got popped out and then I tried to sell it again right away and I got popped out again. So right there I made a swing of minus 200 when it's doing exactly what I want it to do. I'm just getting it at the wrong point. So if you use these kind of inflection levels and try to get above them and you get the 2-try moves and you stick with the checklist, it becomes a really powerful thing. So with that said, I took no trades today, which I'm perfectly okay with. Remember, don't go for a daily goal as far as money goes. Go for I identified X number of setups today. There's always going to be at least one. I've never seen a day without at least one. I want to make sure that I identified that setup and I took action on that setup. So I accomplished one of the two. I identified the setup. I was not able to take action. So I need to learn why I didn't take action and then put things into place to, correct the fact that I didn't take the action on the trade. So that's it for my review on the charts. I'll go over to what I've been working on as far as account sizing and, all that goes. So I started kind of with this bigger table here above, and I'll kind of try to explain it. I was having a hard time following it. So I wanted to see the dynamics are different when you're trading one versus multiple contracts. And the reason I say that is if we're trading just one contract, so the number of contracts it opens just being 1, and the number of that I'm going to close at each of my targets is just 1, because I only have one target, obviously. So that means if my stop is minus 10, I'm going to lose 100 if I get stopped out. And if my target is 15, I'm going to make 150. So net, if I make so say I make 100 trades and I win 50% of the time, which I'm finding is, I'll show you my stats here in a minute for the month of November so far, but if I make 100 trades and I get 50 of them right, I'm going to make money because my target is larger than my loss, right? The same thing goes with the 60% win rate. We just make more money, and a 70% win rate, we make more money. I'm focused here because I want the worst case scenario. I want in the back of my mind, as I'm mentally going through this, it eases my mind to take as many trades as I can, as long as I know that if I make 50% right, I'm going to make money. That being said, I'm not going to just willy-nilly buy and sell. That's what I've always done in the past, thinking I'm seeing something when I'm not. I'm going to follow and stick to my checklist, but every time my checklist fires off and hits exactly what I want it to hit, I'm going to take the trade. As long as I do that and stick with my stops and my targets, I'm going to make money. That dynamic changes a little bit though when you go to 2 contracts at the open and only taking 1 contract off at that first target of 15. The problem is every time you get stopped out, you're losing $200. So I lose that $200 every time I get stopped out, but I only make $150 on that first target. This is done with the assumption that we only get the first target and that's it. We get stopped out of the rest of the contracts, break even. So I'm trying to make this like worst case scenario. So in my mind, I can put some numbers to it and say, well, if I just stick with this, I should be good to go. Anyway, so if I start with 2 contracts and I get stopped out, I lose $200. If I just hit that one target, I get about 150. Now, of course, if I hit the second target, I'm making 350. So 350 is obviously greater than 200. So if every single time I hit that second target, this number this number would be different. But I wanted to do the analysis without hitting that second target. If we look at trading 2 contracts and taking off 2 contracts at 15, you would lose 200 on your losing trades, but you would make 300 on your winning trades. So that goes back to that. As long as I'm making that 50%, I'm making money, right? And apparently I didn't do that analysis at 60%, but let's do it right now. Keep all this in mind, and then I'll show you what my winning percent is in November. Of course, it's not that many days, so it's not like it's something you hang your hat on, but I think it gives us an idea based on everything that I've seen, you know. What the heck? So now we say we won 70 and we lost 30. 15,000 on those. So if I trade pretty good and I get 70% right and I'm just taking those 2 contracts off right away and not waiting for that second target, make some serious cash. I don't know how long it's going to take us to make 100 trades, but I assume you'll find I would assume you could average 2 really good setups a day. Now whether you trade those 2 setups or not, that's up to you and how much time you're spending in it. I've seen at least one every morning, but between the hours of 6:45 and 8:30, 9ish. So there's more during the day too, but anyway. So if you had two trades of the 2 setups a day, conservatively, you have 5 days a week, tradable days anyway. That's obviously 10. So you would have 40 trades potentially in a good month. You could get 40 of these suckers off. So that's about half of what this is, because this is at 100, so a little less than half, 40% of that. So that right there is super encouraging to me, but I would only want to do my analysis in the back of my mind. And I'm not trying to hit dollar amounts per day, remember that, but in the back of my mind, it's like as long as I can just keep making these trades, managing them properly, hitting my 15, stopping out at my 10s, I'm going to be okay. I'm going to make some cash. Of course, it depends on the size and everything, but so then I continue the analysis with doing 3 and taking off and doing 3 targets and taking 1 off at each target. The numbers get larger as the contracts get larger, right? So to me, it's not advantageous to take, say, 3 contracts and take 1 off at each target, because in the long run, if you have 70% win rate, or if you hit your second and third targets all the time, it's going to be profitable. But I think I'm going to start out with doing taking all. If I'm trading 1 contract or 2 contract, both of those, the 1 contract obviously has to come off at 15, but if I'm trading 2, I think both are going to have to come off at 15 for a while until I get really comfortable and see how many times we're hitting target 2 and we're hitting target 3 to really do my analysis. So if we do this for a couple months and we look back at the data and say, well, 70% of the time that I got my target 1, I also got my target 2. So then we can do the analysis on that and actually put the numbers in. We wouldn't have a contract available to actually take the profits, but we'd obviously watch the charts after that occurred. So we say, all right, like I said, 75, 80% of the time it happened. Or maybe we say 20% of the time it happened. That would still change these numbers. So that may change how we trade it. But I think at first, obviously I'm not going to trade more than 2 contracts just to continue to get in the groove. I think the 2 contracts are going to come off at 15, and then we'll watch the data from there. But you're getting your feet wet you're making trades, you're getting your groove into the system. But I think depending on that, how that plays out, if it doesn't play out in our favor and we're getting a bunch of just hitting the first target and not getting second targets, etc., then I think the best way to go is once I go from 2, I'll go up to 4, and I'll take 3 off at the first target and then 1 off at the second target. Taking that 3 off would get you a 450 profit versus when you get stopped out of all 4, you lose 400, so you become profitable in the long run. And then the numbers really start changing when you trade 5 and you take 4 off and then you take 1 off at second target, or you trade 6 and you take 5 off at 15. So that 5 off at 15 is 750, but if you get stopped out of all 6, you're losing $600. And up through, I think you have to kind of shift into once you get into 10, because you can take 8 off at 15 to get $1,200, and that's over what you get stopped out on all 10. So once you get over 10, then you can start doing 8 and 2 or 8 and 1 and 1 or something like that. But we'll see how the data plays out. So this is the initial starting guide, right? So I don't know what you're going to start with if you're feeling good about starting, but probably 2,500 would be the minimum that you would be able to start with. And what I'm doing is just saying, what do I comfortably need to maybe take 10 losses? I don't advise that we take 10 losses in a row, but I'm just trying to look at worst case scenario. So worst case scenario, if I did 10 losses at $100 a loss, I would be down $1,000. I'd still have $1,500 to trade with, right? The minimum amount, which is really awesome if you think about the numbers, the minimum amount to trade one contract is $1,000 in your account. They require that you have $1,000 in the account to cover the losses on one contract if you were to lose. So they're protecting themselves because it's so leveraged that they're making you hold 1,000. But remember the notional value of what you're trading. So if the price of per barrel is 55, we buy a contract at 55. The notional value of what you're trading is actually $55,000 by buying one contract, because one contract represents 1,000 barrels. So if I were to go to the New York Stock Exchange and buy a stock that was $55 and buy 100 shares of it, I would have to have in my account $5,500, right? Now, we're buying 1,000 shares of oil, so I would have to have 1,000 times 55. So I'd have to have $55,000 in my account to trade that. They're giving you leverage, a ton of leverage. So you only have to put $1,000 up to trade 1,000 barrels of oil at the price, whatever price you buy or sell it. So that's why it may not make a lot of sense why I'm so tight with moving stops down and stuff. But the reality is that you can lose a lot more than your account value. And just to be completely honest and transparent, you can lose a lot more than your account value in this market. It's not for it's not for somebody that's just passively kind of trying to get in and out of trades. It's pretty serious because they can margin call you, and essentially what it is they'll get you out of the trade if you go past like 50% of the margin. So if I had one contract and I was down 50 cents, they would automatically get you out of the trade to keep you from going negative in your account. But it is possible for you to go negative your account, because if I'm down $3 on that one contract, it only cost me $1,000 to put on, but I would be down $3,000. If I got out of that, I'd get major margin called. Basically, they're suing you for the difference of $1,000 or $2,000. Anyway, that's why I'm saying the minimum, I believe, would be $2,500 to trade at least one contract in your account. Once you build it up to $5,000, then you could get to 2 contracts. $10,000 up to 4 contracts. $12,500 up to 5 contracts. $25,000 account, you could trade 10 contracts. And I think it makes a lot of sense to kind of build as you go through this. It doesn't make sense for you to start here. This is where I've typically started and tried to trade super high size and then just gotten slaughtered. And this is why I'm going to start down here. I'm going to put probably $2,500 in the account, and I'm going to live with it for a month. If I'm profitable for that month, I'll take all the earnings that I've made and put it back into the account and grow it until it gets to 5,000. If I'm profitable again, I may put another 5,000 in of capital that I have and put it in there because I know I'm being profitable month over month. I'm taking care of the investment. I'm running it like a business. I need to prove that to myself. Amy's going to be basically my accountant on this. I've done this in the dark a lot. She's going to be my CFO. So I've done this in the dark where I take the money and I put it in the accounts and she has no clue, and I trade it and I lose it and I make some money and I lose some money. But she's going to review the statements every month. She's going to be my right-hand man in this. She's going to support it. She's going to say if she's getting the statement and I'm doing really bad, she'll pull the plug. And I'm okay with that because I've lost a lot of money and I know that can happen now, and that's why I'm trying to be kind of as structured and as strict as I possibly can and follow those rules. So I encourage you, if you do start this from somebody that's lost a ton of money in this whole thing, I would say that that's a pretty wise thing to do, but I understand if you don't. That being said, I'll kind of explain it again. Up to 2 contracts, both contracts come out at that first target, so you don't have a second target. When you get to 4 contracts, 3 contracts come out at that first target of 15, and then the next target is discretionary. So in the kind of examples that we looked at today, I would say I'm in here, 3 contracts come out at 15, my stop gets moved immediately down to my point of entry, and then this didn't get stopped out, so my discretionary target would have probably been this trend line. Obviously, looking in hindsight, that's a really bad discretionary target because it went down another $3. But remember, we don't know that. We don't know that until now. That's why this is dangerous to look back. It would have either been there, or it would have either been, sometimes you can use these inverse points. So like right here, where this candle kind of topped, maybe that would have been my point. You can see how it kind of bounced there. Maybe 81. So we're looking about, we got in at 15, 05, 95, 85, so about 35 points. So 35 points would have been my second target on that. So that would have added another $800 total, because on the 35 I would have made $350, and on this portion I made $450. So $800 total in the trade. So this second target is kind of discretionary in how you trade it. After that, move up to 5 contracts, take off 4, then 1, or move up to 10 and take off 8 and 2. You can start to see some of the scale here, even at this level, even at 2. You're returning $300 a trade if you made, let me see what that is, 2 contracts up here. And I hate doing this because it puts unrealistic expectations in your mind. But I want to be really clear that I believe that this is the minimum. This is like the bare minimum as long as the rules are kept. So out of 100 trades, I'd say maybe we make, what did I say before, 40 trades. So if I take that and I say times 0.4, $2,000 in that month. So you're returning and that would be for 2 contracts, right? So that would be returning close to 50% on your money in a month. That's how leveraged this is. Most people will live for 10 to 12% per year on their entire portfolio. Now, when you have $1 million, that's pretty good, $100,000 to $120,000. But when you're trying to build a small account from $2,500 or $5,000, 10 to 12%, it's not going to cut it. You'd have to do that for 20 years before you saw a substantial size account, right? So you have to be making 1,000, 20, 30, 40% a month to get to where you want to be, obviously. So, but it's small steps. It's small baby steps. It's first getting on the simulator and trading it, learning how it goes and whatnot. So I hope this is helpful. I'll get you this table once I kind of refine it a little more. Last thing I'm going to do is show you what we're doing here. What we've done anyway in November. So we finished the second week in November? Second full week anyway. All right, so far, I think the most important, how do I get this blue off? I don't like this blue. Anyway, the most important thing is to understand P&L. So this is all trades all together, $1,100. typically trading one contract. I only started trading 2 contracts basically yesterday and had that one winner on. But anyway, basically one contract, same strategy throughout. Had 1,890 winning trades and minus 760 losing trades. So the important thing is your profit factor. That means for every dollar I risk, I make $2.49. As long as that's 1 or above, or 1 is break even, but if it's 1.5, you're making money. If it's 2, you're making money. I'm not sure what the golden number is. I think you want to obviously be risking enough to be making enough. So that'll be a telling kind of metric. Don't worry about these two. This is based on a $100,000 account. That's why it's saying 1.5%. Not really important for what we do. So 22 trades. Actually, this is kind of telling. 22 trades in half the month. So about that 40, 50 trades a month is probably a good area to be in, because that's from here to here. So yeah, we'd have 2 more full weeks to potentially get 22 more trades in. So right now I'm at a 72% win rate, 16 winners and 6 losers. And none of these really matter because, again, it's a $100,000 simulation account. 6 consecutive winners, 2 consecutive losers. Large and winning trade, these don't matter. About 1.5 trades a day, so that made sense. 5.8 minutes in each trade. Don't know what that is. Don't really matter to us. So the big thing here is going to be the win rate and the number of trades. So if we go back to over here, we're above this level here. So if we were trading the 2 contracts at this this level, where you're taking 2 off at the first target and not having a runner, at the 70% level, and this is for 100 trades, you'd have to bring it down to what we project for the month, which would be about half, right? A little less than half. So we'll say boom times 45, we'll say. So about 6,700. That's on a $5,000 account if you're going to trade the 2 contracts. So probably the goal, once we get into this and you get comfortable with it and you start making some trades and everything, I think the goal would probably be to return 100% on your account every month. And as you scale, get to that $25,000 account, I think, and this is the first time I'm like realistically thinking this is actually a possibility, and it makes me really excited. But it also makes me want to really follow those rules, because could be a lot less if you get to that 50% rate. But the encouraging thing is, even at the 50% rate and only hitting the first target, if you're trying to trade multiple targets, you're still making $5,000. That's insane to me. This just blows my mind, because I've never actually put the numbers like this into paper and kind of understood, if I just stick with the stop and I just stick with the target and I just only make 50% of my trades right, I'm going to make money, and it's going to be awesome. So I'm really excited about this. Congratulations on your marriage. Sorry we couldn't make it. Hope you find these helpful. We'll get together, I think, next week, and we'll go through what we have so far and get you set up so you can get on the simulator. But talk to you later.